So this is going to be a very important video lesson. It's important for you all to listen to what I have to say. I'm going to go over some examples because in my opinion, this is a very, very important concept that not a lot of people focus on, not a lot of people understand. And that's why some people struggle because they go into the market thinking every day is going to be the same. So this video is going to be basically how to identify an imbalanced versus balanced market and basically what that's going to tell us about the context of the market and basically how we should trade around it. So the first point I want to make here is not every day is going to be the same in the market. Not every day is going to be identical to what happened yesterday. Yesterday might have been an imbalanced day where the market was trending, straight up or straight down. And maybe the day following that, the market's balanced, we're cooling off and we're basically balancing out, agreeing on price, waiting for a price to then make its next big move. So it's important to go into every day. Let's say you had a really good day yesterday. It's important to go in now the following day, humbled and being able to adapt and not getting, too caught up on yourself and thinking that you could do it all over again today. It's not the case. The market's going to give you different clues and different things on a daily basis. And that is how you have to look at the market through, different lenses, basically. So there's an infinite number of variables that are going to affect price, volume, time. Your competition is going to be different. Your the orders that go through the market are going to be different. For example, you compare competition and orders together. You could say maybe there's a strong buyer, there's a strong seller, and they're hitting the market with, aggressive size. So these different variables are going to change on a daily basis. It's not really important for us to focus on them. It's really important for us to just paint the picture in our head of what's going on. We don't really care about the details. We just care about what the market is telling us. And because of this, we have to adapt. The key to every successful trader is being able to adapt to what the market is telling us. I don't want to sound repetitive, but the market is going to be different from what it was yesterday, the day before, etc. So the key is being able to adapt and not doing the same thing that you might have did yesterday. Yes, it might work, but the idea here is to understand what the market is basically telling you. And that's going to go with the size and extent of your trades should be based on the market conditions and the setups that it presents itself. For example, I'm going to explain what a balanced market looks like, what an imbalanced market looks like. And then the size and the extent of your trade should be based off of that. So let's say the market is a balanced market. We're trading in a very tight range. I'm going to pull up an example in a second, but this is a balanced market on the S&P 500. When I'm talking about a balanced or imbalanced market, I'm really revolving it around the S&P 500/ES, even the NASDAQ, NQ, because, when we talk about the market overall, we're basically also talking about the breadbasket of stocks that we trade, the Apple, Amazon, Facebook, Microsoft, etc. So when we focus on the market overall as a whole, we're going to be able to bleed it down into the stocks that we do trade. So if the market is balanced, we're trading in a tight range, we're chopping, we're consolidating, that's totally fine. It's very healthy for the market and it's normal. But as a trader, your key is to adapt. And now if the market is balancing out, chopping, consolidating, either there's a couple things you could do. Either walk away and not trade because the stocks that we do trade are not going to have any follow through. And I'm going to break that down as we get deeper into this video. But the stocks that we do trade are not going to have any follow through. So either walk away, don't trade it at all, or size down on your positions. If the market is, no follow through, there's zero volume, there's zero traction to either buyers or sellers, then size down because the stocks that we do trade options on are not going to have follow through if the market's not pushing up or down. So size down, don't trade at all. And just watch from the sidelines. Those are the best pieces of advice I could give if the market's balanced. And your goal here is to be flexible and have a discretionary mindset. If the market is trending, we're moving straight up. Let me see if I can find an example. Let's just say end of day here. If the market's trending straight up and you see a stock pushing down into demand, that's going to be your clear sign. Maybe now I'm going to go bigger size compared to what I would have done if the market was balancing out, where I know that it's going to be tougher conditions to trade in. And like I said, I'm going to break all this down, compare a balanced or imbalanced market in a second here. Okay, so there's a couple of different signs that you could look out for, but you're really never going to know if the market's balanced or imbalanced, until it's actually trading. You're not going to know in pre-market. You're really going to only know after the first 1 hour of market trading. And like I said, we're talking about the S&P 500 in this case. So there's a couple of different signs that you could use, but you're really going to never know it's balanced until it actually is balancing out. And then you have to, trade your setups around it and be flexible with them. So in this case, if you want to look at pre-market, you could really use the pre-market high and pre-market low as a good gauge to know whether the market is going to be balancing out or not. It's a good estimate. If we're above the pre-market highs, you want to see follow through. You want to see us stay above the highs, hold value, and not, break below it. We want to trade above it, attract more buyers the higher we go up. And in this case, we didn't. So, we came back down. We made a low in the morning, rallied past the pre-market high. And then as soon as we got above the pre-market high, we came back down and, we tested this area right here. And you could really consider this area right here a demand zone. If you want to go and really pinpoint it, we had a 5-minute demand zone right here. And if you really want to get deep right there, that's how it would have formed. We broke the pre-market high, came back down, never held value above it, didn't even attempt to trade higher. We just automatically failed, came back down and really tested the range, came back into the average price almost, and basically fell right back into the range. So what's important here is the first hour of trading is you're going to really be our telltale sign. So market opens 9:30 Eastern my time. An hour into the market is 10:30 Eastern. And by 10:30, you have a couple of different things, and I'm going to mark out right now that's going to tell you and help you out to get a good estimate of what the market is doing. So the first thing I look for that I just explained is, are we above the pre-market high and pre-market low? In this case, it could be after hours. We're just talking about the overnight session for the S&P 500. Now, the next thing I look for is what the range we traded in so far at the open. So it could be the first 10 minutes, 20 minutes, 30 minutes. As we get more market generated information, as the market is trading and we are, continuing on with the day, we're going to have more information. Is there decent volume? Is the volume strong and weak? Compare it to yesterday, compare it to the day before, compare it to the last trending day we had up or down. Is it a lot of volume? Is it weak volume? Do we break the highs? And is there attracting new buyers when we break the highs? Did we break the lows? And, is more volume coming through when we break the lows? Because that's going to basically say that there's new selling pressure. And then there's a thing that we call the 1030, which is basically an initial balance of the market. I'm going to explain that in a second. So let me just move this over here. And like I just explained, we came above the pre-market highs, traded above there for 45 minutes, and basically didn't even attempt to push higher. We came down, we failed, we chopped around near the pre-market highs, and then came back down and tested the lows, bounced that demand. So right now that's giving me a little bit of a red flag if I just know, right here, and this is actually 10:25 my time. So right now, the market is really not proving itself to me. It's not telling me we're going to start trending up or down. It's basically telling me we pushed higher and basically failed. And then the volume is also pretty weak. The only real way you're going to get better at this is through screen time and experience. That's how trading is. As you study the market more, you get more information processing through your head. You're going to start recognizing and adapting to basically seeing different things that you previously saw on different days. And right off the bat, I see this volume on the S&P and it's automatically telling me that low volume, Now the next thing, the volume was low, it was weak volume. What was the range that we traded in so far at the open? So we opened up at 3283, made a low of 3276, and made a high of 3292. So not the smallest range and not the largest range. It is definitely a tight range compared to what we normally see on the S&P 500, where we get rips of 30, 40, 50 points. So a 15-point range within the first 2 hours of market open is really nothing compared to what we normally see on the S&P 500. So look at the range. If it's small, that's going to give you a little, a bonus point to pointing out that the market may be balanced today. Next thing is, did we attract new buying, making new highs, new selling when we broke the lows? So this is also going to come into our 1030 initial balance. And basically what the 1030 initial balance is that we look at price at 1030 and we see the range that it trades in, and we basically mark the highs and lows. This is what I do. So here we have a high. Here we have a low. Let me remove this. And here we have a high. So now we have our 1030 initial balance. It's basically telling us the high and low from the first hour of trade of market open. So what we want to see is, we want to see us come above or below the initial balance, and we want to see new buying happening. We want to see us stay above the high or above the low, either balance out to create new demand or supply and for another leg higher or lower, or if we come above the initial balance or below the initial balance and fall back into the trading range, that's basically going to give us another clear sign that the market may not want to move today and it may be balanced. So the initial balance, just mark out, you can have it in your head too. Just mark out the high and the low from the first hour of regular trading hours and see how price reacts when we come above the high or above the initial balance low. And basically, if we fail the first time, and we come back and trade in the range, most likely it's going to be a balanced and out day. So we attempted to break the high. You can look at the volume down here. There's nearly no volume to confirm that there's new buying above the high. And that's why we, from the 1145 all the way into, I guess you could call it, 110. So 2 hours, a little less than 2 hours, we traded in a 6-point range after failing to break the high. So at this time, it looks like this, completely choppy, no follow through, no volume. It's basically a red flag in my head saying, don't trade this. Or if you're going to start trading this, trade smaller size. And the stocks that we do trade are not going to have any follow through. So if I pull up the stocks that we do trade, your Facebooks, Amazon, Microsoft, Apple, the market bleeds, and basically, it bleeds down to the personalities of the stocks that we do trade. Look at Microsoft, completely choppy, completely sideways. There's nowhere for you to get a good entry and trade this on Microsoft. Same thing with Apple. Yes, you can argue that we had a nice strong push at the open, but what happened after the open? Did we bounce at a demand zone that caused this bounce? No, we didn't. There's nothing over here. We gapped up and made a complete rush, push up to the upside. So unless you're scalping this move to the upside, which personally I don't do, I buy at demand. If we created maybe a 5-minute rally-based rally, it would have taken that long. But this opening move after that, Apple did absolutely nothing. We sold off, took profit, and we traded sideways. There's nowhere in this area on this chart where I personally would have got an entry and would have taken a trade here. Same thing with Roku. There's nowhere on this chart that I would have got a position. There's just no follow through. It trades sideways. There's no clear trend or direction. Therefore, I'm not going to trade it at all. Same thing here with Amazon. If you want to look at a low break, because I know a lot of people like buying breakouts and breakdowns, which personally I don't do. We sold off in the morning. Maybe you could have got this short if you look on a smaller time frame. Maybe you could have got this short after you saw us breaking down. You got a couple points out of it. You scalped it. Totally fine, totally cool, depending on your strategy. But comparing back to the S&P 500, after we sold off, we traded in a tight range for Amazon. We traded in a 15-point range, which for a $3,100 stock, 15 points is nothing. It's not even, I don't think, half a point. Or it's half a point, yeah. So, same thing with Facebook. Came down, came up, came down, came up. Impossible to trade that. And then top right, we have the NASDAQ. It's a major market. Same thing with the S&P 500. Came up, sideways action, traded completely sideways. This is what a balanced market looks like. And this is how it bleeds out into the stocks that we do trade. Now going back to the S&P 500 example, we finally did break the high. No volume to confirm it. Let's see down here. No volume once we broke above the high. Broke above the high. Didn't attract any new buying, and then we consolidated above it, didn't even attempt to break above 32.95, and we then sold off and came back right into the middle of the range, hence why this is a balanced market day. And the next example I'm going to show you is a trending market and basically how to trade around it, because balanced markets you have to adapt and not trade as normal as you would or the same as you would based off of the next example I'm going to show you, which is a trending market. So now this is an example of a trending day, and if you want to go back to the checklist, obviously there's going to be some different variables that you can't really see until the market is actually trading and the candlesticks are fluctuating. You're going to be able to see, volume coming through. You're going to be able to see the ticks and how the candles do react to volume and certain orders. But let's go back to the checklist. And are we above the pre-market high or low? In this case, we opened up at 3,220. Pre-market high is 3,222, and the high yesterday is about 3,224. So about 4 points away from the pre-market high, and we sell off. Look where we sell off to. We sell off right into VWAP, and immediately we start bidding higher. Buyers step in here at VWAP at the 3,206 area. And we pushed up from 3,206 to 3,230. So about a 24-point range, compared to the previous example, which in the first hour we moved in a 12-point range. So right off the bat, this range is double compared to where we were. Buyers stepped in, and basically right here, what this is telling me is, we sold off pretty aggressively, and buyers stepped in. So now we have aggressive, eager buyers. Volume is okay, nothing crazy, nothing weak either. We're in the 20,000 mark, almost 30,000 mark, and buyers step in pretty aggressively, automatically bid the stock up, break above the high. We break above the high, and then we don't get rejected immediately. We continue to push higher until we start finding some sellers, and we get a healthy pullback to the downside. Now, like I said, this is a trending market. And in trending markets, you typically find rally-based rallies where we rally higher, we base out, and then we rally again for another leg higher. And these are the days where you're going to find on higher time frames the stocks that we do trade. Let me pull this up here. The stocks that we do trade, you're going to be able to find higher time frame rally-based rallies. So we rallied, we based here, and then we rallied again. You could take it, out of speculation that there's going to be a rally-based rally, or you could wait for confirmation above the high, and putting your stop loss wherever you're comfortable and wherever your risk tolerance is. In this case, I probably would have put it below this red basing candle. But my point is here is on trending days, up or down, you're going to find, obviously if you're talking about the upside, you're going to find rally-based rallies. And if you're talking about the downside, you're going to find drop-based drops. So that was Microsoft on a 30-minute. Let's see, Amazon, same thing. We rallied, we based here, and then we rallied again. You could take it long once we break above the rally base. Out of speculation that a rally-based rally is going to form, putting your stop loss below the basing candle or wherever your risk tolerance is. If you go into a smaller time frame, I'm sure you're going to find different pictures. Let's see what else we got here. So let me just minimize this. So that was a trending day in the S&P 500, and then this is what it looks like and what it bleeds out to on the stocks that we do trade. The stocks that we do trade have a clear direction. Obviously, this is a trending day to the upside, and the key is focusing on stocks that are agreeing with the market and basically are moving with the market. Microsoft, as I just showed you, agreed with the market. Amazon, same thing. Facebook, same thing. We rallied, we based out, we rallied again. Apple on the top left, same exact thing. This is when you're going to have the strongest moves. When the market is trending, there's clear direction, there's volume, and there's follow through. So looking back at the 1030 initial balance, did we attract new buying when we made new highs? Did we attract new selling when we broke the lows? The 1030 initial balance is basically going to tell you that. Like I said, visually, as you do this more often, you're going to be able to see this. So at 10:30, we had a high right here, and the low is right here. So that's our initial balance. Come above the initial balance, we sell off. But this is a healthy pullback. This is basing out. We pull back, sellers take control, but then all of a sudden buyers take control, and now you have market participants agreeing on price. We balance out, we're basing out, picking up new orders for another leg higher, hence why we get a rally, a base, and then another rally. So this is what a strong trending day looks like, and this is when you're typically going to get your all-day moves, your all-day faders to the downside, your all-day runners to the upside, and these are the days you have to capitalize. Now that you recognize it's a trending day, now maybe when you see a rally-based rally go a little higher size, let your winners run a little further. Don't take profit as fast as you would on basically a balanced day. So actually, I'm going to make a checklist and tell you the different things that I personally do once I understand the direction of the market. Are we trending? Are we balanced? Is it a strong day? We have aggressive participants? I'm basically going to break that down. So you aren't going to know it's a balanced market, and balanced markets is a consolidated market, or an imbalanced market, which is basically a trending market, until the market is actually trading and we start receiving some market generated information basically as the day is moving forward, like I said. So here's what I do on balanced days. I just made a little list. So either on balanced days, I stay sidelined. I don't trade at all. Like I said, there's not going to be opportunities every day. Your goal in this market is to trade our setups, to trade your own setups. It's not really to trade the market. The key is finding the setups that you're used to, the setups that you trade, the setups that you have an edge in that worked for you in the past. Key is finding them and trading them. You don't need to trade every day. The market's always going to be here. It's going to be here tomorrow. It's going to be here in an hour from now, etc. So either stay sidelined or don't trade at all. It's all about preserving your mental capital. And if you sit in front of a computer screen all day trying to find a setup when nothing is setting up because it's balanced market, then you're just going to go crazy. That's personally, how I feel. Also on balanced days, I take smaller position sizes. So, as the market's balancing out, obviously there's going to be less follow through. So why go with, 50 contracts and get chopped up with trading options on a balanced day? Go smaller position sizes. Your objective with trading is to play defense. You're not supposed to play offense until the market tells you to play offense and tells you to get aggressive. So on balanced days, I take smaller position sizes just to play defense and just to protect myself. And then same thing. This is another defensive mindset type of thing. On balanced days, you have to take profits faster when you have them. You can look to scalp on balanced days. Get in quick, get out even quicker. Take your profits fast when you have them, because obviously there's no follow through. So at one point when you might have had profits, if you wait, to get greedy and you want to get a couple more points out of it, a couple more bucks out of it, you might not ever get it, and you're going to regret not taking profits faster when you actually had them. That is a balanced day. Now an imbalanced day, which is a trending market, which is basically like something like that. These are the type of days we're going to get all day runners, all day faders to the downside. The market's imbalanced. We obviously have aggressive sellers or aggressive buyers. There's an imbalance between buyers and sellers, hence why we get a trending market. So in this type of market, you can leave a couple contracts to ride the trend. So let's say, I don't know, hypothetically speaking, you get long, right here somewhere, I don't know, just a random pinpointed spot on the chart. Let's say you take profit, you have the best exit, you take profit right at high of day. Instead of selling 100% of your position, maybe sell half of your position or 75% of your position, which goes along with the take profit video. Then now you have 5 contracts remaining out of 10, and now you could hold on to this afternoon chop where the market's balanced, and get a nice afternoon push with your 5 remaining contracts, and you've basically rode the trend. So that's what you're going to see on trending markets. And your position sizes could be a little larger since we have clear direction. There's not no indecisiveness. There's not no balanced market. We have a clear direction up or down. So you could take larger position sizes. And you could also be a little more aggressive. Instead of going with smaller position sizes, 10, 20 contracts, maybe go with 50 contracts, depending on your account size and depending on the position size. But on imbalanced days where there's clear direction, where the market is trending, I tend to go a little more aggressive because obviously we have a strong imbalance, we have strong buyers, or we have strong sellers. And coincidentally, as the time I'm about to upload these videos to the course and actually add them, today we had a balanced market. And basically, it was a good example to show you exactly what I did just previously explained. I'll show you what I looked out for too. So on the S&P, ignore these other drawings over here. We blew past all-time highs. All-time highs yesterday. Over the weekend was about 3395. Now we're gapping up about 30 points higher than that. Very strong in pre-market. There was very bullish sentiment this morning. And, I wanted to see some follow through to the upside, but obviously we didn't get it. And I was able to recognize that within the first hour and 15 of the market open. So pre-market high, we made 3424. Market opened, continued the trend from pre-market, came down, and we found buyers at VWAP. Keep in mind, this candle right here is a 10:30 candle, 10:10 candle. So the first 40 minutes of market opened, we moved in a 9-point range, which is nothing, in a 5 minute period a couple months ago, we were getting 9 point moves in a 1 minute period. On a 5 minute candle a couple months ago, we were getting 20 point moves. So this is really nothing compared to what we average trade. Volume's pretty decent too. I'm not going to comment on that because it's not really that low. And then we pushed up. We made an attempt at the pre-market high, immediately failed. Next thing I look for is really a 1030, and at 1030, our balance, our high was right here, and our low was right here. 1030 candle is right here. So now it's important to see what we do when we break the high or the low. Break the low, come down 2 points. So this looks like a massive sell-off right here from the low of the initial balance to the low of the day. But that's only a 2 point move. Then what happens? Immediately buyers step in. We come back into the trading range. When I'm talking about the trading range, I'm talking about the high and the low, and basically the median, the average price, where time has spent the most time, or where price has spent the most time. Come back into the range. What looks like a big move is really an 8 point range within the next half hour, 45 minutes. And then we chop, a lot of doji candles, no follow through, very choppy sideways. And, at this point, even right here, I could tell at 12 o'clock, the market's going to be balanced. Even, right here, market's going to be balanced, 11:30. So it's just a balanced market. And, there's just nothing going on. There's nothing that's going to set up. There's going to be no trades, no crazy volume. It's very hard to trade this, and you have to adapt and make yourself not force any trades when the market is doing this. I'm going to pull up the screens with my stocks. And let's just look at, Apple. Apple sold off this morning. Cool. You might have got a nice sell-off from here. There was no supply above. We did sell off, bounced, but there's just nothing really here that's giving me a clear direction besides the first, hour, whatever. It looked straight down. Microsoft, same thing. Up, down, up, down. Amazon pulled right back into demand. Nice entry right here. If you caught this long at a 3-hour demand, came right back up, rejected right off VWAP. This would have been a nice trade. I actually put this into the chat room today. But, very little follow through. That's why you have to take your profits fast. Normally, if the market was trending, we bounced off demand, we would have ripped to the upside. We only were able to catch, 40, 50 points off of this move today. If you bought at the bottom and sold at VWAP. Hindsight trading. Facebook, same thing. Rallied in the morning, got completely dumped on. Looked like a nice rally-based rally, but, dumped on completely. And now just trading completely sideways. Same thing with NASDAQ. Same thing with Roku. Straight down, straight up. Very hard for you to find the setup in these type of market conditions. Very hard for you to trade it. And very easy for you to get chopped out and take a losing trade because you want to actually trade something. No reason to trade during these days, and I hope you guys got that message with this video.